Hello, everybody. Today is Monday the 18th. It's 1 o'clock here in New York. Thank you guys for joining us today. I'm my buddy Imran. Imran, how you doing?
Hey man.
So we got a lot of stuff to cover today. One, the market is, obviously quite weak here. I think that there are a lot of macro flows kind of coming into and out of the market. So we want to talk about that. We want to talk about the VIX expiration. We'll touch on that briefly. You and I aren't terribly sure if there's a big impact headed our way through that. But then we obviously want to lead into this big January expiration and talk about some of our views. You can give some insights on the dealer flows and give your point of view on some of the data we just put out yesterday, and then we'll take some Q&A. So we'll try to keep this about an hour, and we know it's a volatile day, as I said before, so we'll respect everyone's time and try to keep it concise. So first, Imran, do you want to tell everyone who you are and give some background on yourself?
Yeah, sure. For those who don't know me, I'm Imran Larka from Options Insight. I'm an options trading provider. I've been chatting to Brent for that year now, right?
Yeah.
Doing these expiry breakdowns. I used to be a professional trader for a bunch of big top tier banks. Also spent some time on the buy side, and now I teach the masses about options. So check me out on options_insight on Twitter.
Cool, thanks. Nice. So let's kick it off here. Just a general market view. I mean, the market is obviously kind of breaking down some of these new levels. In our morning report, we put out that we thought the S&P would find some kind of a bottom in and around 45.75. So that's basically right here, right now. And we'll see if we catch a bounce here. But one of the dynamics that we were just talking about, before we went live here, was the fact that, volatility, if you look at the VIX term structure in particular, my comment was, we're not seeing a lot of backwardation here, right? I'm not getting the feeling that like the options market is aggressively looking into short-term puts, and you had sort of a little bit of opinion on that. My opinion was that I think that could be a signal that some real money players are coming out, and this is higher interest rates are leading to rotation and tech selling and the like. What's your sort of view on why maybe we haven't gotten that backwardation in VIX or even S&P really?
So my observation was that these levels that we've got on S&P are not levels we haven't seen before, right? We saw these levels in December. So remember literally the day after December 3rd Friday expiry, we had that leg lower of about a couple of percent, which I think bottomed out at 45.35, I believe. Okay, so if into that year-end period, you had a bit of de-risking anyway in the market, right? You had a lot of real money and people de-risking. You then had that sell-off, so anyone who hadn't de-risked kind of got forced to de-risk. And then we've rallied strongly, caught a few people off guard, but now we're just back kind of around those levels or slightly. So I don't think at this level of spot, because the sell-off's been more about rotation and hasn't taken the S&P to new lows or new local lows, let's say. If we were to break below 5,500 and see a 4,400 handle, I'd be very surprised if we didn't start to see a flat to slightly backwardated curve, or at least get close to that. But I'm not overly surprised given what the realized has been recently. Like there's been a bit of intraday chop, but close to close, it hasn't been massive. And I think those absolute levels on the S&P, because it's rotation and it's not just broad market selling, I think that's playing a large part into what you're seeing on the VIX.
Yeah, and first, sorry everyone about the echo. I forgot to put my magic microphones in here. So Imran, I think that sort of snaps or syncs with my view, and I think what my concern here is if the options market just decides that, look, we want to buy short term vol, like we want short duration puts, and we flip to backwardation and the VIX spikes up over 25, that could put a lot of pressure on the market vis-a-vis dealers having to sell futures to keep those deltas hedged, and there could be a scramble for some protection. Now, I'm putting you on the spot probably with this question a little bit, but there are some smart guys out there talking about the breakdown and correlation specifically, between S&P and bonds, right? And there was a talking point about that around the March crash. The idea that there were some instances or there were some periods in there where that whole 60-40 portfolio where bonds are supposed to hedge your equities didn't work all that well. And there are some signals now that correlation is obviously not working out all that well. I mean, yields are going higher at the moment. And my point here is that going to drive the vol market, right? Are people going to be looking to go into vol as the only available hedge? I mean, if Alpha Exchange is a good guy to follow on this specific topic. But do you have any thoughts or insights there?
I think that's a very valid observation, in that what's driving a lot of this weakness is coming from yields, right? And normally you have this correlation: when equities is risk off and sells off hard, bonds save you. But at the minute, bonds are the reason why equities is selling off, right? And it's because the market is massively repricing how behind the curve the Fed had become. You look at inflation rates versus wage growth. You've got negative real wage growth, which is putting massive political pressure on Biden. His approval rating is absolutely tanking, and he's telling the Fed, you have to do something now, right? You need to shock this market to get rid of inflation. Now, the truth is, whether jacking rates 50 to 100 basis points this year is going to solve the inflation problem or not remains to be seen, given that a lot of the inflation problem is coming from this kind of structural supply chain issues that we have been getting. So we've got to wait and see how that plays out. But that's certainly been the driver of the change in stance from the Fed. The market's waking up to that, and the market's almost trying to force the Fed's hand into raising rates sooner rather than later. Like, don't be surprised if you see a March hike, and some people are calling for a 50 bip hike in March. I think that would be insane for them to do, because I don't think that would help them in terms of their goal of bringing down inflation. I think that would just tank the market, which they don't want to do either, even though some people think they don't care about 20% sell-off. I think those people who think they don't care about 20% sell-off are smoking something. I think they do care about a 20% sell-off. But I don't know where the Fed put is lower than it was, but there is still some kind of Fed put, I believe, right?
Yeah, I think as a whole, I mean, if you just look at how well Congress trades, they care about the market. They care about the movement of equities. I think that the market in general is a big signal as to how strong their policies are and the like. So, if you look at this breakout in yields, and, if nothing else, as you mentioned, this can bring pressure on stocks, on tech stocks in particular. A lot of the memes are really getting beat up, and those are the leaders of the market, obviously. So you're going to get your Apples, Teslas, Amazons. Those things, could get pressured a little bit, more because of this. But certainly the other thing that's interesting is just how badly, the NASDAQ and a lot of these other stocks. I mean, I was looking at Robinhood this morning, and, this thing is down to a $12 billion market cap. I mean, there is a bear market for a lot of individual names. And, the S&P, which is, I think the reason it hasn't fallen is that sector rotation, right? It's holding up because people are selling tech, but they're buying energy, or they're buying this or buying that. And, that's that diversification, I guess, that the S&P provides.
Yeah, I mean, the ARK Innovation ETF is the poster child, right? And it's getting crushed, right?
Yeah.
So,
and that's an interesting one, because for me, because of this January OPEX. So I want to touch on that in a second, but this thing, I mean, I don't want to get on a pedestal and start talking about ARK, but there's this selection bias, right, where the fame and the attention that these funds got as a function of just being in the right spot in the right time. I mean, innovation vis-a-vis a lot of names that had pretty poor fundamentals, those stocks were part of meme mania, right? And that is not necessarily, yes, I'm sure she's a talented, or they're talented money managers, right? But how much of this performance was a function of, right place, right time, as opposed to necessarily, picking fundamentally the right stocks? I mean, it's, I don't know, it's a challenging thing.
The way I see it is, the premise of these ultra growth names is, if you got free money, you got rates at zero, then yes, cash flows in 10 or 20 years time are worth quite a lot, right?
Mm-hmm.
But the minute you have an actual cost of capital, the minute you have some actual interest rates, then these things get annihilated, basically, right? Because their cash flows are so far in the future, they ain't making any money for 10 years. right?
Yeah.
Therefore, they're not worth much today, right?
Yeah.
That's the difference, right? It's just a discounting. That's all it is, right? Discounting of future cash flows. These guys have only got future cash flows. They have no current cash flows. In fact, they have current negatives, and that's the whole valuation, right, of these type of names, and that's what we're seeing repriced as rates go higher. Now, hopefully, rates can't go that high, because that would just tank the entire economy because debt is so high. So you've got the long end of the yield curve kind of capped. It seems like 30 years not going through 220 just now, even though the front end's going parabolic. So if the long end of the curve
Quite a move.
if the long end of the curve doesn't steepen, like 2 years at 104, right? But the 10 years at 180 or 185, and then 30 years at 220. So, the terminal rate, as long as that doesn't suddenly jack 200 basis points higher, if that goes 200 basis points higher, oh my God, ARC's going to like 30, right? But if they can keep that long end of the yield curve kind of in and around where it is, and we just continue to see this flattening, then I think ARC's starting to offer you maybe a bit of a opportunity to play a dead cat bounce or some sort of rally, right? Because
Yeah.
it is hated right now, right? I mean,
Right.
there's no positive press on that.
And I would agree with that. Actually, if you look at the stocks that make or comprise of ARC, Tesla is one of the huge ones, and so you can make the case after this Jan OPEX. If we do get a big sell-off, OPEX-driven sell-off, it could be an interesting, bottoming sort of in that area. So let's move on sort of slightly from that. I want to talk, do you have a view on VIX expiration? I mean, I typically don't find a whole lot of correlations or, a lot of information embedded in the fact that the VIX expiration is either before or after OPEX. I've heard some people say that there is, but I quite frankly don't really have much of a view on that.
No, I think the VIX, I haven't been trading the VIX for a while. My general MO was to buy puts or some sort of puts on VIX or VXX in vol spikes. But I'm just starting to think that these vol spikes now are becoming quite frequent and may well last a bit longer given the macro backdrop. So I'm kind of not really bothering buying these VIX puts these days. So I haven't really checked out where the open interest and stuff is. But personally, I feel like, you don't really get, this is my opinion, you might disagree based on any data you've seen, but I think because the vol of vol is so high in the hundreds, you don't really tend to get such a strong gamma effect on VIX strikes that keep the VIX pinned to any particular strike, unlike you do on S&P, where the vol's more like in the teens and the gamma gets enormous, if you know what I mean.
Yeah, and for me, it's just I think statistically, probably try to back out and figure out. I think the idea is that if the expiration happens before or after a big equities options expiration, that could exacerbate or shift volatility in a certain way. And I suppose maybe at the extremes that could be the case. But I'm with you. I think in general, we flag the VIX expiration as something to be aware of in case like wonky things happen, particularly around the open tomorrow when it settles. But I just don't have a terribly strong view on that. So I think I want to sort of shift slightly ahead, talk about the main thing here that I think most people here want to talk about. Oh, one quick point here. Alexander mentions risk parity unwinding, and that's quite an interesting moment or topic to talk about real quick. If we just shift back to the rate piece, right? Risk parity. I haven't looked recently at the size of the risk parity market, but the idea is that if there's a lot of volatility in rates in bonds, right, and there's a lot of volatility in equities, which way do these guys allocate or shift to? Generally, you want to shift out of equity volatility and go into the safety of bonds. But if they're both sort of selling off, those are one of the kind of wheels comes off the bus, so to speak.
Yeah, that
right?
makes sense. Totally. When that correlation flips between bonds and equities, then as general volatility rises, then they have to dump both, right? They have to degross the book basically, right? Because there's no correlation benefits. They just have to take the numbers down because both legs of that trade are hurting you at the same time, right? So for sure, there is some potential for a bit of a cascade. Should VIX go through 30 in the not too distant future, yeah, I could see a bit of risk parity unwinding that needs to be done for sure. If it's not already, it probably is already happening. It's probably why we're seeing this bond market weakness. I mean, 2 weeks ago we had the worst bond market sell off in one of the worst in history, basically, right? So
Right.
it was pretty brutal. Yeah.
Yeah, and the moves are really kind of something else. So, all right, now let's quickly shift here to the topic of the day. I guess is the January options expiration. So we put out
Mm.
a lengthy article about this on the SpotGamma blog. We made a quick video sort of discussing our views. And there's always going to be someone that gets upset about whatever it is we're going to say and do here. So our point with this whole thing is there are some very large in the money calls expiring on Friday. Now, there's a range of outcomes that could happen here, but if there was no options expiring, we wouldn't say anything, right? So there's a bunch of deep in the money calls expiring. We don't know how those are positioned. I think it's on a name by name basis, right? If you look at something like Tesla, I would wager that is probably a lot of long call holders that are deep in the money now, and they're feeling pretty good about that, right? Whereas if you were to shift over to an Apple or something, maybe it's more a blend of short and long calls, so the extreme delta readings are a little more neutral, right? And so what we're really trying to figure out here is how are these things hedged, right? And how might the expiration lead to an unwinding of hedging, if there are, right? So along with the caveat, some calls could be long and some could be short. That would lower the delta exposure, right? The other option is that obviously some people could just hold their calls to expiration. The dealers who are short calls versus hypothetically long stock would take delivery or have shares pulled away from them, right, on the expiration of those calls or assignment of those calls. And so the dealers will be flat and they're good to go, right? And I think that's kind of what the prevailing argument is. I would argue that there are certain circumstances like Tesla where the exposure is very large. And so just give an example, right? If you look at I haven't checked today, but if you look at the money call in Tesla for next year, for January, for the leaps, it's about $25,000 notional to buy an at the money call, one at the money call in Tesla that expires in a year, right? So let's say that last year you paid $25,000 for that call. It goes deep in the money. You now got to come up with another roughly $80,000, right, to have that stock assigned. If this is a lot of retail, for example, which obviously $25,000 for one call is a lot, but the Tesla people are fanatics. They love Tesla. They'll put their money where their mouth is in terms of investments. The question that I have is, how many people will take an assignment on that and actually take delivery? If you look at, as another really crude example, the Pelosi trades, she likes to buy, and I suspect that a lot of private wealth is therefore in a similar vein, where they like to buy slightly deep in the money calls, slightly in the money calls on a bunch of tech names. And if one rips, doubles in the year, then, that leverage gave them a lot of benefit, right? I don't think that they want to take delivery of 4,000 or 5,000 shares of, say, Google, and then hold that stock, right? I think they sell that stock and then roll into new calls for the year. So,
But I've got a question though, right?
yeah,
Like,
fire away, please.
if they didn't want to take delivery,
Yeah.
then why have they not sold the calls already? Like, why would they not wait? Well, why would they wait until the day of expiry? Why not just sell the calls and then you got a load of money to play with because those calls have multiplied in value handsomely, and then you roll those calls and but if you want to stay long, then buy some out of the money calls expiring later this year, next year, whatever. Like, I don't understand the motivation from a retail guy who's bought calls that have made 5x to decide the day of expiry is the day I'm going to let them expire. Like,
Well,
I
I
don't
mean,
get.
I think that's kind of the point. I would agree with you. It's just sort of you're arbitrarily picking a date, right? And so we can
Mm,
monitor the deltas as the kind of week progresses, and ultimately you don't know who is holding these names and why they're holding them, right? Um,
mm,
so your point is valid. I can't argue against that. I can't
mm.
argue for why someone would want to close today versus when the stock was at 1,200, right?
Yeah.
There's a myriad of different things there, and I think what my kind of overarching message here, right, is that I don't think that I personally would look to play the expiration heading into expiration, right? But if these names are particularly weak on Friday into Monday and Tuesday, then I had the feeling that that is heavily influenced by a large expiration, right? So I don't need to guess. I'll wait for options expiration to
Yeah.
take place. And if we get big selling on Monday and Tuesday, that's going to signal to me that, okay, maybe some people, be it dealers or maybe it's vol funds unwinding Tesla calls or whatever, Tesla deltas, excuse me. And that could be a signal to me that, look, a bottom can be because there's this artificial selling so to speak, artificial on the hedge unwind, right? And I can look to play that mean reversion.
Yeah, and I would argue that we've seen enough volatility in and around, whether it's a couple of days before expiry or a couple of days after expiry, so regularly in the last year, we've seen a bout of vol, particularly to the downside, into expiries, that it has typically been a buying opportunity, right? So
Mm-hmm.
just based on that back test, right, that simple back test, that look at every expiry, if you get a sell-off either just before or just after, that typically is a bit of there's a high probability that that's a local low. Just on the back of that, I think you could build a case to say that. And I agree, you don't need to front run it and say, oh, well, I'm going to buy it now because of that reason, because you don't know how deep that's going to go if it does happen early next week. So maybe what you do is, if you get a sell-off early this week, you buy some March calls on stuff that you like. And if you get even more of a sell-off early next week, then you have more conviction to actually buy stock. Maybe that's the way you do it. I don't know.
Yeah, and I think you can get that. You can get that same. So I don't think it's not a big S&P expiration. And what happened was, when we looked at last year, I mean, first I would just note, here's the December expiration, right? The end of year December expiration in Tesla. These options expirations tend to mark oftentimes interim highs and lows. And you and I were talking too before about, March 2020. And I said, look, the low in March of 2020 right here was the day after OPEX. And you correctly noted that there was, big Fed intervention or whatever that was announced. But if you look at this other date, December 17th was a big low December 2018 was a big low. That was also the day after options expiration. So there's always these coincidences to me. And my point was, this is an extreme delta position. I'm sure people weren't just naked short puts, into March of 2020, and whatever it may be, news, or maybe it's the fact that the news had more impact because those deltas, those put options were gone, right? It's unfortunately very tough to know for certain, whatever it may be. But the fact is, you can flag that there are big positions expiring. And so if we do get extra volatility on Monday and Tuesday, then we can have some reason behind it. And I think then you can make a better informed decision of, possibly buying a dip right on Monday and Tuesday.
Another way.
Oh, I'm sorry, go ahead. No, please go on.
Another way I would phrase it as well is, like, a lot of people who look at charts and technicals look at cycles, and they look at various cycles, okay, to establish, and there are patterns, right? You get these time cycles, and you get patterns of weakness or strength in the market based on certain cycles. I think one of the cycles is called the kitchen cycle, right? And it's like an 8-year cycle that kind of coincides with the business cycle or something like that. It might be a 4-year cycle. I can't remember, 4 or 8. But point being is, it looks like we've got another cycle at play here, which is the options expiry cycle. Because as options volumes have exploded in the last 2 years, for whatever reason, the culmination of flows and options expiring every month at the same time of the month has created this expiry cycle where we are starting to see quite repeatable events happening in the market, right? So I just think incorporating that cycle into your thinking probably does add some value to you as a trader.
Right. And I think too, even if you're, say, in private wealth where you're looking to allocate, funds for people, or an RIA or something, using those OPEX cycles can be a very interesting time, right? You want to buy Apple or whatever it may be, and you can look for those options cycles, those third Fridays, right, to possibly allocate in. If you got to buy anyways, that those could be good, possibly good, times to consider, allocating into those events. So, we talked about ARK before, and ARK itself is not necessarily a large expiration. I think actually there's mainly puts that are in here for the ARK. You can see about $3 billion in delta, which is not terribly large. That's a negative delta, so those are mainly puts that are in the money. Not surprising given that the stock is so weak. But the issue with ARK, which is an interesting one, is that Tesla, I believe, is the largest holding in this particular AR, the innovation fund, which I believe is the biggest. And so ARK could just be pushed around by whatever flows are obviously happening in the constituents, right? And then they also have the idea, it's sort of a self-reinforcing cycle. If you get redemptions, and the selling of ARK could lead to the selling of Tesla, and it can be the kind of the spiral in a way. So that could be an interesting, rebound play. But the fact, again, that ARK itself doesn't have big contracts expiring doesn't necessarily mean a whole lot if the constituents, again, like Tesla do.
Mm-hmm.
So, those are my general OPEX views. I mean, I think I've spoken about this kind of at length in another video, and then answer some questions on Twitter and the like. If you want, we can move on, take a couple questions here. If something else comes up you find interesting, but we're coming up on about half an hour here. So we will.
I mean, I would just add that because clearly we're seeing Nasdaq price action that confirms that the street looks like it's short gamma, right? So we're
that's a
seeing
very good point.
quite a lot of high frequency short dated volatility. It's whipping around. It can't find any equilibrium and stability. So maybe you just trade the chop, right? Maybe that's the way to trade the Nasdaq for the next few
Right.
days in expiry, right? You don't get too big a position and you just trade the vol and you expect it to oscillate quite violently. And that's how you benefit from the fact that it's in short gamma territory. So you're not going to necessarily get a stability. You're just going to get these gyrations. Just take your size down and trade as if you are long gamma in a market that's short gamma, basically.
Right. And that's a beautiful point to bring up. I mean, the rallies and the directional moves that you can get in these markets, as you can kind of see on the screen here, are very, very large, right? I mean, look at that rally kind of in the NASDAQ late last week, and then now we just kind of made the round trip. The NASDAQ cap was a very negative gamma position, which is just basically telling you that there's a lot of put options, in the money put options now in the queues. And I would say, sort of from my view, I don't see a lot of large contract positions expiring in this Friday's expiration in the S&P. I'll have to double check the queues, but I generally, again, look for the expiration of big put options as a bottom, a time to look for a bottom in stocks. And at least in the S&P, I don't see that. But granted, again, in the S&P, the relative move lower has been smaller than that of tech and certainly of IWM. I mean, I was just looking at this chart of IWM, and I mean, this is a pretty ugly chart, So clearly, the other indices, the rest of the market is feeling something that the S&P is not quite yet feeling. So let's take a couple questions here. If anyone has it, you want to put them in the chat. We're kind of scrolling through. We'll just see if we can help them. Yeah. So Paul's asking, what's up, Paul? In the AM note, we mentioned 45.75, and we're talking about how we're evaluating that level. So the 45.75 level is. I'm not supposed to type that in there. The 45.70 level is the big level that we outlined this morning in the morning note, and I'll show everyone why we call out 45.75. So in this Equity Hub tool, what we're doing is we're monitoring the change of gamma is basically what this chart is showing you. So think of it almost as like what they call speed in a way, the third derivative of delta. And so what you see here is that at 46.45, there's this big sort of peak.
Are you sharing? Because I can't see, so I don't know if you're able.
Thanks, Imran. Got to get better on my controls here. Sorry, everybody. So this is our Equity Hub tool, and what we're showing here is the rate of change of gamma. So basically what you notice here, there are these, what I would just call peaks, right? Around 45.50 and around 46.50. And what that is essentially telling us is there's a lot of options, put options in this case, at these levels, basically 46.50 and 45.50. So the rate of change of gamma is very high in between these levels. And what we found is, these levels being 46.50 and 45.50. And what we found is that where these sort of the trough in between these peaks, for lack of a better descriptive term, tend to be support and resistance levels. So when we're looking at the 45.75 level, that is where that is basically derived from. And if we switch views in a second, I'll show you, where these, where that pocket of gamma is basically that this is detecting. But basically what it's showing is, and the idea is essentially that there's a lot of hedging adjustment in between these levels, and that hedging adjustment should take place around 45.75, and that's what leads us to look for a bottom here in the S&P. And you can see that, we said this at the top of the broadcast, I guess to call it, that 45.75 could be a decent support level. So hopefully, Paul, that helps to answer that question. I think if we actually flip over to this other chart, we can see specifically that pocket of gamma that I was referring to. Andrew's asking, are we able to put a notional value in the risk parity deleveraging? Chris Cole did 5 or 6 years ago. I'll be honest with you, that is not something that I would know how to sign a figure to. Imran, is that something you may?
No, I've not seen data on that. I would like to. I'd like to see
Yeah.
data on that, but I haven't.
We need Chris Cole to come back to Twitter. He's disappeared for a while there. So here's this sort of big put strike basically at 45.75. You can see that this is a combined gamma profile. So what this is looking at as all the gamma in the SPX and the SPY, and you kind of combine that, and you end up with this level at 45.75 being a fairly big, what looks like a put strike, and that is sort of what that other signal was
So
picking up.
that big strike creates a trough in the previous graph. Is that what you're saying? Yeah.
Right, because the idea being that there are, and I don't know if these are short-term or longer-term options or what, based on just this quick view, but generally the idea is that as the market comes into this level, there's a lot of gamma here, and that would cause a hedge adjustment. Is essentially what the idea is.
Okay. Yeah, I mean, I think the level you put out last week was 45.80, and it nailed the bottom of the market like within a tick. It was insane.
Yeah, well, thank you, Imran. I mean, it's quite interesting how this model forecasts these short-term bottoms, and I guess the other way to think about this is that because that position is there doesn't mean the market is going to test it necessarily, right? But if we do get that test, it can be an interesting bottom. But I think one of the things that also in a way is showing us or telling us is that there are hedges in place there, right? In other words, if we for some reason break 45.45 here, there's not another sort of interim low, so to speak, until basically another 50 or 60 points, right? So it's this change of hedging. This is picking up sort of the rate of change of hedging, but it's also just telling us, look, there must be puts here, right? There's obviously a ton of positions down at 4,000, but it's almost like a signal that the market is somewhat well hedged in this case.
Mm-hmm. And also the whole put wall thing, right? Like, where are you putting the put wall on S&P right now?
Yeah, I believe the put wall, good question, was at the 4,600 strike. I should have looked.
Okay, so
we looked that up. So we'll show everybody in the our sort of morning note. So for those of you who are new, we put out a morning note. We analyze the S&P and the Nasdaq every single morning. We send out this report that covers basically how the options position has changed overnight and what we think the ramifications of that position change. But essentially what we pick up is the put wall is at 4,600. So what that put wall is telling us is that most of the largest net negative gamma position, and that's gamma position, is at 4,600. The movement of this put wall often signals the shift of, we think, sort of hedge flows, obviously, in the market. And we have some stats that say that the put wall, shifting to a higher strike is a very bullish signal. 62% of the time when this put wall shifts to a higher strike, that's a signal that the market could rally. If it shifts lower, that is not often actually a material signal. But generally what we look for is that this is a support level in markets. And the idea being that when the market sells off, gamma will spike or increase as we approach this level due to the large put position. And that is why we sometimes think that this can be a market low. Marco Polo, options derived from looking at the VIX chart is technical analysis. I put a little joke in there last week. I put a chart and I said I was doing some technical analysis, and we got a lot of people going. All right. Love Twitter. Let's see. Any other questions in here? Sorry, we'll just scroll through real quickly. Yeah, the put wall was breached this morning, and that's a good point. I think we pretty much opened, just over that 4,600 line in the morning. Kind of broke low, but again, 45.75 is this big level that we mentioned in the morning note, and that so far seems to be holding. And kind of what the general idea is here too, if you want to talk about, the Vanna trade or whatever, is that really if the market stalls out here, that crushes in particular short-term puts, right? The vol comes out of those puts, and that is what could provoke a cover rally, something like we saw on Friday, where volatility comes in, implied volatility comes in, it hurts the value of puts, and that can lead to something of a short cover rally, right? As deltas are bought back, as puts are closed, and that can sometimes cause a rally. So this idea that the market sells off fairly hard, it hits the support level. But if the market just sort of stalls, that's going to slowly put a tailwind into the market, I believe, because implied vol is going to start to come down, and that can lead to sort of a short cover rally. If you're long, the puts that expire in a day or two, these positions, and you didn't close it here, those puts are rapidly losing money now, right? As the market sort of bottoms and starts to rally. So I think you have to be pretty active in trading those often. Darius, you're a good friend of mine. Hey, man. Does the lack of large index options expiration this week negate or offset any bounce we're likely to see on the other side of the hefty single name OPEX? So that's a great question, Darius. I'm going to be actually talking with Darius tomorrow and if you go to Macro 42, you can get some information on that. Imran did an excellent interview with him a few weeks back. But basically, it's a great question. And if you look at last year, and we have this chart of last year's options expiration. If you look at last year, it was a very, very large options expiration akin to the size that was on this year. Now, the issue with sort of trying to compare, obviously, is that last year was one of the most insane times of the market that I've ever witnessed. I'm sure, Imran, you'd echo that, right? With this was the week, literally a year ago today, that the GameStop stuff happened, and AMC and Robinhood, needing a capital call. All of that stuff is now exactly a year. But this is the deltas expiring today, right? Or excuse me, on Friday. And we have a chart here of last year's expiration. You can see it's just as big, right? And so when you try to back test this or look back at individual single names and say, hey, what happened last year? It is so tough to figure out, which end is up, basically, in terms of what options could have done. Now, I could argue possibly that the options expiration exacerbated the volatility that we saw last year. Who is really to say? But my sort of point is that goes back to what Darius is asking, is that the net move on the S&P from the expiration into basically the February 1st was net flat. Market didn't do anything. It had a 4% range. So it had a very volatile range. But if you look at some of these single stocks across different sectors like, Disney, Tesla, et cetera, in general, those stocks were all weaker. A lot of them sold off. Names that had big expirations did see new lows after the expiration last year. But again, there's so many crosswinds and currents involved in last year. It's hard to sort of sync that data up.
The general message, though, correct me if I'm wrong, Brent, that you're saying is, if you're looking to get long this market, right, because you think a few of these tech names are pretty beaten up, you still believe that there might be a bit of a push higher in broad markets. Omicron's going to basically give us herd immunity at the end of the pandemic. These type of things that Darius is calling for as well. Maybe I shouldn't say calling for, right? Or let's say hoping for. Basically, excuse me, I don't want to speak on your behalf, Darius. But basically, if you're looking to buy this market, would you be saying wait until sort of after expiry to see if you get this kind of cleansing of positioning post expiry, because people have been assigned a load of deltas that they don't necessarily want, certainly in the single names, because that's what's going on, right? Like a lot of the time, I remember from being on the desks in the banks, like my single stock colleagues wouldn't know what the delta is going to be until Monday when they come in, right? Because the single stocks, it's not like index where you know exactly what your delta is. All of your options are going to get exercised automatically. Like in single stocks, you have a choice, and sometimes people exercise an option when they shouldn't do, right? And stuff like that, because it allows them to get liquidity, basically. It allows them to get into a stock position because it's physical settlement. So I think a lot of what you see post-expiry in singles is a bit of that cleansing where people know what their actual position is now. Yeah. They can then get where they need to be, and then the market has its move. So is that what you're saying?
Yeah, maybe people, every single long call that exists is simply exercised. Every deep in the money long call is simply exercised. And then on Monday, you got to figure out what your allocation is, right? Oh, I'm too long tech. I got to trim some of that and buy some, value or whatever. I don't know. But, so I went through about 50 different names trying to figure out across different sectors. I was looking at retail names, but then you go, well, GameStop screwed up XRT so much last year that how can you possibly look, you go, hey, okay, it was because of OPEX that, some random retail name moved around when, again, there's so many cross currents. But, just look at like Disney, for example, here's where options expiration is. And then, again, there was the Robinhood, issues, and there was some general market weakness. But, a lot of these names had these flows where you saw that the low came in sort of the days after options expiration. Sorry, I didn't show this chart here, but this is the Disney chart here. A lot of them look the same way, where you see this this general weakness. Now it's a similar thing here where there's macro issues going on. The rates are changing. It's just a weak market in general. So does expiration compound those issues? I can make an argument that is quite possible, and I'm sort of with you that it's this cleansing of these positions, so to speak, that may lead to some volatility here.
Yeah, and you need more vol supply for the street to find some equilibrium as well, right? So typically, we're talking about the expiration cycle. Well, it's also a cycle of options activity and options flow. And so, certainly when I was still on the desks, you got a lot of vol selling in that last week of expiration coming to the tape, right? So that was normally an index, but what that did was that supplied index traders with a bit more gamma, a bit more local gamma than maybe they had before. And so that will then bring stability to the market, kind of take some of the sting out of these moves where people keep chasing it. And then you can build off that and maybe rally if we do get some more positive dynamics going on in the market. Right now, I mean, every rally's getting sold pretty sharpish, but that like I said, that may change once the street gets given more vol, right? And there is a lot of systematic vol selling that will just be there, right? So
yeah, and so someone here asked about GameStop, and what was sort of interesting to me about these positions, and this kind of ties into what we're talking, is for a very long time, the biggest delta expiration in GameStop and AMC in particular was the January expiration, this one coming up. Those positions got closed and went away, I believe, in late December, right? And we talked about this 40 pin for months and months and months. We talked about this 40 pin. I must have done 20 videos on this thing. And
are you talking about GME or AMC?
I'm sorry, I'm talking about AMC. Sorry, I had the GME chart. But the GME chart, I think, was kind of the same thing, right? There were these big options positions that came in late last year, and I think those were volatility linked positions. Maybe there were people that were long or short those leaps, those January positions, whatever they may have been. The 40 strike was the dominant strike up until roughly December, and then those contracts that were tied to the January expiration all got rolled out, such that now the biggest delta expiration, I believe, in AMC and GME are in 2023 or something, right? Those positions basically just got closed and went away, and that was like the rug pull happened in these names, and they cannot catch a bid really ever since that. And this ties back to like who owns all these deep in the money call positions. Well, I don't know, but I do know that they're expiring. So whatever their trade was, is now gone. It's now changing, right? And is that just going to change the flow that goes into these names, right? It's a challenge to say. You can make an argument that if the Tesla calls are a part of hedging, convertible bonds or something like that, well, those calls might have added to the bid that was in Tesla and persisted for so long, and now maybe those calls are going to go away because the bonds are going to settle out or whatever it may be, and that's just a change in flow, right? Someone asked specifically about GME. I mean, I have a hard time seeing, quite frankly, the GME and AMC saga as just kind of a sad kind of transfer of wealth. Ultimately, I hope a lot of people made a lot of money in here, but I think the fact of the matter is that these things had supportive options flows. Those flows are gone. If we look today, we just see persistent call selling and put buying in these names, and it's just a lot of pressure, and they're sinking overall with just the market. I mean, AMC is still, I believe, the top the top stock by weight of the Russell, so of the Russell 3000. So it's tied heavily to a lot of these index flows just in general. In terms of Tesla today, so we have this system called Hero, which is our real-time options flow. It's in beta. We're going to launch it hopefully in February. We're going to put a lot of more information about that, but basically allows us to see the intraday real-time flow. So I'm checking that over here on this other system. I would show it to you all if I had the permission to do so. But basically in Tesla, what we're seeing today, big trade just went off. Looks like on the put side. So today we're seeing people selling calls. That is the general flow, selling calls in Tesla, and it looks like overall that leads to a pretty big negative delta day for that stock and just sort of tech in general. So I think on that. Oh, I'm sorry, Imran. Go ahead.
No, just saying. So are you going to be keeping an eye on Hero on like the broader indices towards the end of the week to see if there's any sort of profit-taking type flows on puts?
Yeah. So one of the things I've done, it's a good question, Imran, and it actually reminded me before we sort of close up things here, is that on our blog, what I decided I was going to do is I was going to post the hero flow for Tesla every day, and Tesla in particular. I'll just take this one stock. So if you go to our blog, you look at Tesla tracking. I'll post the deltas every night. So around midnight is really when the options open interest gets updated. So I guess I'll be updating this every morning. I'm just going to show how the deltas are changing every day. At night, I will post information about the hero flows that tells us which way the deltas went, long or short, and we'll track this thing and see what happens over the next week or two. So if that's something that's of interest, you guys want to see how this plays out, maybe nothing will happen and it'll be a thud, or maybe we'll track some really interesting flows, but that'll just be sitting there on the blog. In terms of the S&P flows, just for those of you who are watching the market now, we saw a pretty good bid in spider deltas here, which seems to coincide with that 45.75 level. You can see that we actually got a pretty good bounce there. So thankfully this went my way. I don't have to explain anything else. I said 45.75 support and we went to 45.50. I would have to end the broadcast early. Just kidding. All right. All right, Imran. So a few things to talk about here as we close up. I want to thank everybody for taking the time here to join us. We have a couple of really interesting things to talk about. One, for those of you who may be looking to fill some of the gaps in knowledge that you may have around, Gamma, Vanna, all of the basic options terms. We have this excellent course called the SpotGamma Academy. We got this handsome fella, Imran, who actually leads the course. Imran, a lot of people ask, hey, Brent, why didn't you lead the course? Imran has extensive course material. He's obviously extremely smart, but he's been training banks for a long time. So, this guy knows what he's doing. He knows how to structure the course material. He knows the ins and outs of how to, put the building blocks together at a fundamental level so that you can start to understand those advanced Greeks. So he's the course leader there. If you go to academy.spotgamma.com, you can check that out. You can also go over to SpotGamma, hit subscribe now. You get a free 7-day trial. Interesting week to get a free trial, right? Of our products. So you get the daily notes from me. We're going to give subscribers a spreadsheet to download that looks like basically this of the expiration flows daily, and then you can access to our equity hub, obviously that monitors the options positions. And Imran, if people want to get a hold of you, you want to let them know how to do so.
Yeah, sure. So my website, options-insight.com. You check that out. You can get a 15-minute free call with me or my team to discuss all our services. If you take part in the hedge course that is on SpotGamma, you get a free 1-month subscription to my macro insight service, which is basically
That's right.
me weekly on Zoom, talking about the markets, talking about what's going on the whole macro space, including crypto, how I'm playing it, what the vol market's telling me, and all that good stuff, basically.
Nice. And we recommend in general people start the trial, the macro insights trial, after they complete the course, right? We had a few people that started a little early.
Yeah, so
it's kind of
get
better.
that free month. Yeah, you get that free month for macro insight as part of the hedge bundle. But you also get Q&As with me for a month via SpotGamma anyway as part of the hedge bundle. So you're better off coming to those Q&As, benefiting from all of that weekly insight and Q&A. And today's one was a great one. We had some really good questions on today's hedge call. Quite advanced questions, actually. People were asking options and
Glad
stuff
you
like
were
that.
answering those ones.
It was great. No one was asking what is a basic call spread payoff or anything like that. It's quite good. But anyway, make the most of those hedge calls. Once that runs out, then activate your free month of macro insight, and then you'll really you'll get the bang for your buck that way, basically. Yeah.
Sweet. And I'm also going to be, so again, I'll be talking with Darius Dale. He's on the chat here. He runs a great macro service over at Macro 42, and you can find out about that chat there. I'll be interested to get some of his views on interest rates, and then we could piece together how that might affect some of the equity flows going forward. So thanks for your time again, Imran. I know you're over in London, so it's late for you, so you're probably happy to get some rest here as well. And we'll
Yeah.
catch up with everyone soon.
Cheers, Brent. Take care.